Hey guys! In this video we're going to go ahead and look at how to determine if a bond is issued either at face, issued at a discount, or issued at a premium. Now there's a couple different ways to determine if it's issued at a face, discount, or a premium, and the first is to compare your stated and your market rate. So if they're equal, it'll be issued at face. If your stated is less than your market rate, it will be issued at a discount, and if your stated is greater than market, it will be issued at a premium. Remember that discount and premium don't mean good or bad, it's just kind of what it is. Now, the second way to determine if your bond is issued at face, discount, or premium is to compare the cash you receive to the face value. So remember, we calculate the cash we receive at issuance as the present value of the future cash flows of that bond, and so if that present value or that amount of cash received is equal to face, then your bond is just simply issued at face. However, if the cash you received at issuance is less than the face value, then your bond is issued at a discount, and if the cash you receive at issuance is greater than the face value of your bond, then that bond is issued at a premium. Now, I like to first compare my stated and market rate to make an initial determination on if the bond is issued at a face, discount, or premium. However, once I am able to calculate the amount of cash I receive, I compare that to my face value just to confirm that it matches that initial conclusion I had. If it doesn't, then something either went wrong in my initial comparison or in my present value calculation. Note that if you're given either only your stated and market rates or only the cash you receive in the face value of your bond, you're able to determine what that bond was issued at by that information alone. So just to add numbers to this, if the face value of the bond was $1,000 for each, a bond issued at face, you would receive cash of $1,000, whereas with a discount you might receive cash of $900, basically anything less than that face value, and a bond issued at premium you might receive $1,100, or essentially anything above that $1,000 face amount. I think it's also helpful to look at what this looks like on a balance sheet under your liability section. So we'll go ahead and look at that now for each of these examples. So your bond payable will always be on your balance sheet at the face amount. And so if your bond was issued at face, your total liability at issuance would be that $1,000 amount. However, if it's issued at a discount, your bond payable, again, always at that face amount, would be $1,000. However, you would have a contra liability account, which would be a discount on your bond payable, and that would be an amount of $100, and that initial balance would be $900 on your balance sheet. If we're looking at a bond issued at a premium, you would again have your bond payable at face of $1,000, but you would have something called an adjunct account, which is a premium on your bond payable because that will actually go towards increasing the liability shown on your balance sheet to show a balance of $1,100. Remember that the goal here is to amortize that discount on your bond payable to get it to a balance of 0, so that on your balance sheet you have that face amount of your bond payable left. And basically the same thing with your bond issued at a premium. You want to amortize that premium account so that it moves towards 0, so that all that's left on your balance sheet at the end of the life of your bond is the $1,000 amount of face. So just to add clarity, again, this balance sheet is looking solely at issuance, and then over the life of that bond is when you're amortizing your discount and premium accounts, so that on your liability section of the balance sheet at the end of the life of the loan, you only have the face value remaining. So hopefully you found this helpful. Thanks for watching.